Lacy Hunt just said TLT will move higher, as the direction of long-term Treasury yield is downward. Why recession has already started. Stock market is getting greedy again. From the Fear and Greed Index, it has showed 65 greed in Monday's session. Surely, more and more investors are turning bullish. When the S&P 500 breaks above the bear market down trend line from a year ago. So what then? Are we going back to a bull market already? Technically, you could say as S&P 500 has a golden cross above the 200-day moving average. If you haven't watched my last video about the stock market volatility, go watch it after this one, as you will find out how many months of a good time that we can still enjoy before the real deflationary crash happens. I admit I was wrong last year. I thought that the Taiwan situation could be the trigger for the market to crash, but I was wrong, obviously. Keep that in mind though, as that could always be a concern for the market. Today, we're going to talk about why Lacy Hunt believes long-term US Treasury yield will go lower, meaning TLT will go higher this year, why he thinks recession has already started, and when. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get it into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? Based on 1976 Nobel Prize winning, a truly outstanding economist, Milton Friedman, in order to determine inflation or deflation, or try to determine where interest rate is going, you need to find out money supply and money velocity. He made important contributions to price theory as well as macroeconomics. He postulated that MV equals PT, where M is money supply, V is velocity, and PT is price multiplied by transactions or GDP. This leads to the question, what is money? Most economists use M2 as their measure of money. What about velocity? Friedman made an error in his equation. He assumed velocity was constant, or at least relatively stable. Velocity is neither constant nor stable, but it was relatively stable when he wrote MV equals PT. Lacy proposes using other deposit liabilities, ODL, as a better measure of money. So change ODL with money if you're confused. The main difference between ODL and M2 is that ODL does not include currency or retail money market funds. Currency is accepted at an increasingly fewer number of business establishments and simply cannot be used for very large size transactions. Retail money market funds never became an important medium of exchange. Both are becoming a far less used medium of exchange. ODL has the additional advantage that is the main source of funding for bank loans and investments, making ODL both a monetary and credit aggregate. Friedman would not be surprised that the need to change the best definition of what constitutes money would change over the years. Friedman's theory of money and inflation. Although Friedman's monetary theory of inflation has justably drawn criticism, major components of his theory of interest rate cycles remain intact, and the so-called flawed aspect can be overcome by converting money velocity, V, to an endogenous variable rather than assuming that V is stable. Once restated, the model applies very directly to the current interest rate outlook and suggests that even though the Fed is planning further increases in the federal funds rate in 2023, the direction of long-term US Treasury rates is downward. Today, we will modify Friedman's theory to incorporate an endogenous V and then apply the new model to the situation at hand as well. As to the tumultuous events of the past 3 years, the determinants of velocity to be identified serve to reinforce the review that the US Treasury bond market's prospects are favorable, even though conditions are very likely to remain volatile. During Friedman's career, he first argued that M1 was the superior money measure than M2, and later in life, he experimented with other definitions on the assumption that the velocity problem could be solved if money could be properly quantified. Velocity is affected by cyclical, fundamental, and idiosyncratic forces, while all are constantly at work. The evidence shows that two fundamental forces, the marginal revenue product of debt and the commercial bank loan to deposit ratio, are dominant over time. ODL money growth is estimated to have declined at a record 7.9% annual rate in the fourth quarter, following decreases at 2.7% and 1% annual rates in the prior 2 quarters. From the last quarter of 2021 to the same quarter in 2022, nominal ODL money is estimated to have declined at record 2.8% annual rate, the largest yearly drop in history. In real terms, ODL money also contracted at a record pace. Based upon the Fed's monthly $96 billion balance sheet reduction and the monetary policy lags, the rate of ODL money decline will accelerate at least in the first half of 2023. If the Fed sticks with its plan to raise the federal funds rate another 75 basis points, the rate of decrease in ODL money will be sufficient to neutralize the money mountain of 2020 and 2021. By the second quarter of 2023, when taking velocity into consideration. Lacy's final thoughts. The rise in velocity in 2022 is a stark example that V is determined by the actions of the private sector, not the Fed. This is the essential aspect of an endogenous variable. if velocity has been stable in 2022. The Fed would very likely have come much closer to restoring their goal of a 2% rate of increase in core inflation. But the inability of the Fed to achieve their target quickly does not mean that they will be denied success. The planned actions are moving the Fed closer to realizing their inflation objective. The risk of recession will become much clearer as 2023 progresses. Headline inflation will recede further from the 1.9% pace in the CPI of the latest 6 months. These developments are aligned with interest rate cycle theory, as well as the case for lower US Treasury bond yields. Lacy Hunt said, "I think the recession started in November." Right now, the primary strength left in the economy is a reduction in consumer demand for goods. The reduction in demand reduced the trade deficit and thus added to GDP. Some cite jobs as a strength, but Lacy noted the declining work week. The average work week has peaked and total aggregate hours is rolling over already. Recession lead time versus industrial production tends to be very small, typically 1 to 2 months. People tell me a recession won't start in 2023 because everyone expects ones. I disagree. I replied, a recession won't start in 2023 because it's already started. That's the true contrarian position. Just a reminder, don't miss your windows of opportunity to add TLT to your portfolio. By the way, we only paper trade on this channel, not financial advice. And this is my client's collaboration book. It is called It's Already Yours, Adversity Equals Success. Such an amazing book with such incredible authors. And my book, Rainbow Focus. You are such a good boy for watching my video right till the end. Bye.